The following presentation is intended for financial advisors only. This event may include statements that contain forward-looking information, and such statements may be subject to risks and uncertainties, some of which are significant in scope and by their nature beyond the controls of the investment advisor. There can be no assurance that such information will prove to be accurate, and historical results are not necessarily indicative of future performance.
Greetings, I'm Mike Hurley, Chief Market Strategist for NexPoint, and this is our weekly market deep dive for Monday, April 19th, 2021. Well, starting as we always do with commodities in the US dollar, you can see the big news last week was the weakness in that greenback. Looking at the center chart near the top, you can see the DXY index failed at its 40-week moving average, which is an area we've been watching closely. Additionally, the dollar index is not oversold yet, far from it, and losing momentum quite rapidly. So we think the dollar weakness is likely to continue in the weeks ahead. This has helped several commodities because, again, a weak dollar leads to strength for commodities. And you can see in the top right, the crude oil is holding support and moving higher on the week. Copper also had a nice week. You can argue that the Bloomberg Commodity Index moved out of a bullish flag pattern, as did the Australian dollar, which is a commodity-related currency. Finally, one other thing I'd like to point out on this slide is the difference in the charts between gold and silver. Gold has been weak for 3 quarters now and is, again, trying to turn around, but remains below its downtrend. That being said, gold is oversold, and the Commitment of Traders report is in a bullish configuration, suggesting a rally in gold may be nearby. Silver, on the other hand, is forming a slightly higher low, and again, is in better shape, relatively speaking. We'll talk more about that later. Looking a little more in depth at both of these charts, you can see that the crude oil contract, as measured by Brent crude, was up last week. The spread between the 1 and 12 month was up last week as well. And that's really a wind at the back of crude oil. Important technically is that crude found support at this downtrend, which it had gotten through several months ago. So again, it's good news for crude to have gotten through resistance, pulled back to digest those gains, and held. On gold were higher as well, which is good news for gold. You can see gold in both dollars and euros on the right-hand pane. And again, that uptick over the last week is good news. That being said, the divergence between the blue and the yellow line in the top right is cause for concern longer term, but we're going to give gold the benefit of the doubt here. As for the action in the bond market with US interest rates, it was really quiet to somewhat negative over the short term. You can see a daily chart on the top left of the 10-year US Treasury, and it got a lot of attention last week by slipping through this area around 1.6 to 1.62. That it was support over the short term, and again, could be considered a breakdown, but not much of one given the nice rally we've seen this year in the 10-year. Again, it's been quite strong, going from 1% all the way up to 1 3/4 quite quickly. And these 3 horizontal lines are important support levels to watch in the weeks ahead. As long as any one of those hold, the uptrend in yields should be considered intact. So again, likely a pullback within an existing uptrend. I'd like to move on to another slide, which is kind of interesting from a good friend of mine, Chris Verrone from Strategas. Chris put together what the recommendations on the sell side were, or for research analysts and economists for the 10-year, not only last week, but 3 months ago. And you can see sentiment has changed pretty dramatically in the interest rate market. Specifically, 3 months ago, you can see by these red bars, 54 of 58 sell side forecasts were for yields to be sub 150 12 months out. Last week, however, 44 of 56 forecasts by economists and fundamental analysts were for yields to be somewhere between 1.5% and 2%. So definitely economists and analysts moving their targets higher on the 10-year US Treasury from where they were 3 months ago. And my favorite part of this piece is his tagline at the top. That is, nothing changes sentiment like price, which is absolutely true. Very difficult to find someone bullish on yields 3 months ago. However, they move a little bit higher and everybody's jumping on the bandwagon. Looking a little more at yields globally, you can see from the right-hand chart that yields have moved nicely higher over the last year. Last week, they were mixed, however. You can see the US 10-year down 8 basis points, Japanese down 1, German up 3, and the UK down 1. The US 10-year break even was higher by 5 basis points, which is good news because it is that 10-year break even that's been leading the markets higher. As for the chart on the left, that's the US yield curve this week in green, a month ago in the dashed olive line, and then 6 and 12 months ago with the lower lines. Point being, while the yield curve has steepened pretty significantly over the last 6 and 12 months, over the last 1 month, it's eased a little bit. So again, another different but similar look to that consolidation we're seeing in the interest rate market. Looking at credit spreads were wider on the week for the first time in 4 weeks. The bounces were pretty manageable or pretty small, with investment grade only up 1 basis point, high yield up 3, and triple C's up a mere 8 basis points. So while they are up on the week, it was the first time in 4, and these charts remain near cycle lows. So again, credit spreads are definitely not a risk to the markets, and if anything, a tailwind, not a headwind. We're going to take a little bit different look at our long-term look at the market this week. For those of you who've been tuning in on a weekly basis, you know that we usually show the value line index here with the percentage of stocks above the 200-day within that index. This week, we're showing the S&P 500 with, again, the percentage of stocks above their 200-day average. I like to use this indicator in a couple different ways. One, when it's above the 40% level, it's a good indication of a bull market, and below 40 of a bear market. Again, looking at the next slide, my good friend Chris Barone also did a pretty neat statistical study on this indicator as well last week. He noted that when this indicator is in the bottom decile of readings, or the bottom 10%, meaning a very oversold configuration, the returns going forward over the next 12 months are a bit mixed, meaning a pretty wide range here of gains and losses in the market. Conversely, when the indicator is very overbought, which is thought to be a bad time to buy the market, you can see the returns are much more consistent and largely positive. So again, a very overbought market sounds like a bad thing, but it's actually a sign of strong momentum, and momentum that will usually carry forward. Again, think of throwing a ball at the sky. The ball has the most velocity right when it reaches your hand. As the ball travels higher and higher, it certainly slows down, but it keeps moving higher. And that's the best way to think of a market like this. So let me go back one slide and show you the S&P 500 with the percentage of stocks over its 200-day. So again, here's very oversold, and here's very overbought. And surprisingly, when the market is overbought, you often see consolidations, but 12 months later, it's higher. Here's another good example. Very overbought, 12 months later, higher. Very overbought here, 12 months later, higher. Very overbought, 12 months later, higher. We've been overbought in this market for 3 months, and we certainly have gotten higher over the last 3 months. Looking a little more tactically at the stock market, we've got daily charts of the S&P and NASDAQ on the left, weekly charts in the middle of them, and then to the right, weekly charts of the small caps and mid caps, Dow Industrials and Dow Transports. As you can see, last week was a good one, particularly for the S&P, where the S&P continued to score record highs, nearing 4,200. We're going through just about 100 points in the S&P a week now, which is a good week by any standards. Breadth and leadership are what I would call adequate, meaning if you look at the number of new 52-week highs on the New York Stock Exchange, they are a good, solid number. On the NASDAQ, however, market internals, again, the pulse and blood pressure of the market, are a little bit weaker or significantly weaker. Again, the last time the NASDAQ was up here at 14,000, you were running a large number of new 52-week highs, much larger than you are now, as you can see here in this bottom chart. This divergence is also apparent on the weekly chart. Again, the NASDAQ had a pullback approaching new highs, yet the advanced decline line is showing a couple of lower highs, meaning breadth or the number of stocks moving higher while the index is moving higher is a net negative. Similarly, the number of stocks making a new 52-week high is waning as it is on the daily chart. That, again, is a very different picture from the NYSE or the New York Stock Exchange, where you see the S&P 500 quite strong, breadth is also quite strong, forming a higher high, and you have an adequate number of new 52-week highs. In addition, the MACD, or the trend following MACD, is on a buy signal. So again, a much stronger market in the New York Stock Exchange than the NASDAQ. Stepping back and what it probably means, particularly when you see corroboration with the Dow Industrials making a new high, the Dow Transports making a new high, and the mid caps making a new high, while again, the small caps continue to breathe, is it still looks like a strong bull market or a cyclical bull market, and one that will continue higher in the months and years ahead. That being said, when you start seeing these divergences, it does hint of a potential change in leadership and a potential rally into a significant top that could be a trading range for many months. We're not there yet, but it looks like that's where we're probably headed, a bull market that may be headed for a more extended trading range. Looking at market sectors, this is where you also get a defensive flavor to the tone of the market last week. If you look at the table on the left, I put green boxes around the utilities, the healthcare sector, as well as REITs. So 3 of the 4 strongest sectors were defensive in nature, or sectors that typically do well when the market is weak. Just below, which I didn't highlight, are the consumer staples. And again, consumer staples typically do well when the market is a little bit on the weak side, and the staples actually did better than the S&P last week. The FANGs remained relatively strong as well, meaning Facebook, Amazon, Apple, Netflix, Google, Microsoft. And you can see that the large growth stocks, or the Russell 1000 growth, was up 1.8% when the rest of the indices were higher but didn't lead the way. If you look at the volatility surfaces this week, there was not much change again. There was not much change last week, which you could see by the flat volatility difference surface over here on the right. A little bit of a spike higher on 1-month call options, but that really just reverses the 1-month dip we had last week. So again, not much change in volatility at the index level. Where you did see volatility change, and again, this matches what we're seeing on our sector slide, is you're starting to see the 3 defensive sectors a little stronger than some of the others. Again, the green line, meaning call volatility skew, up above 80% in healthcare, certainly above 80% in consumer staples, and moving higher again in utilities, whereas put volume skew is moving lower. So again, green is good, red is bad, and when green is higher, it means that sector is seeing a bullish configuration in the options market. I also wanted to continue the theme that we started on the first slide with the dollar weakness. When you see dollar weakness, it should be matched or followed subsequently by strength in commodities and strength in commodity miners, in addition to the overseas markets. And you can see here we have charts of Newmont, which is clearly breaking its downtrend that it's been in over the last 3 quarters and reasserting its uptrend. This is an example of an extended trading range that, again, the market could fall into the back half of this year before ultimately continuing higher. Freeport-McMoRan has had a smaller consolidation range, but again, the stock is continuing higher. Coeur d'Alene is a big silver miner. And Albemarle does a whole lot of mining in things like lithium and those types of more basic metals. So again, these 2 haven't responded yet, meaning Coeur d'Alene and Albemarle, but those are bullish charts that look to be offering viable dips in an uptrend. We're looking to them, however, is not to recommend them, but to watch for confirmation or corroboration with that dollar weakness. Finally, I also wanted to show two charts on the bottom, which were two companies that were very affected by the Archegos hedge fund blow up over the last month. That on the left is Credit Suisse, and to the right, Morgan Stanley. Both were quite exposed to that blow up. Credit Suisse had $4.7 billion in losses, and you can see the market cap declined by roughly $5 billion to match that loss. Being a larger company of about 5 times, Morgan Stanley also had a hit its market cap, but again, it's far less visible in the stock price compared to Credit Suisse. Credit Suisse is about a $27 billion company, and Morgan Stanley nearly 150. So again, roughly 5x the size. That being said, there was about $1 billion in losses at Morgan Stanley, and you can see roughly $2.5 billion came off the market cap. Looking at the overseas markets, it was an interesting week for the overseas markets. And again, one that doesn't entirely reflect that dollar weakness quite yet. Several weeks ago, we did talk about that MACD buy signal, or the trend following buy signal on the S&P 500. And this week, we finally saw matching buy signals in the ACWI, or All Country World Index, as well as the EFA, or the overseas developed markets. The EFA is dominated by markets such as Germany and Japan. Think overseas developed markets. And you also saw a buy there. The notable standouts on the week were the DAX in Germany, which traded at a new all-time high. You can see it's extending nicely off that breakout. The French market traded at a new 52-week high. And certainly Japan and Korea maintain strength and bullish charts as well. Finally, if you look at the top right, this is one of our key canaries going forward. We've talked about it a couple times, but I think it's very important how the Chinese markets handle their recent pullback. You can see a couple of months ago, they scored new highs after leading the whole world higher by breaking out in the spring. They're now pulling back. These pullbacks are holding their 40-week average, however, which is exactly where you would expect them to, and exactly where those markets should find support. They're not moving higher yet, as Newmont and things like that have. But again, should this dollar weakness continue, you should see strength in these overseas, particularly emerging markets. If that happens, that's good news, because these were key canaries back in the spring. Finally, on our COVID slide of the week, I think what was interesting and maybe a little bit of bad news here was the top right. It is a survey from the U.S. Census Bureau that says there's currently 4.2 million adults which are not comfortable enough with the COVID situation to go back to work, which I think is unfortunate, because if you look at the top left chart, you can see that the number of cases and deaths has declined sharply off its peak. Also, what was interesting is, I think, this horizontal box in the middle, which is a study from the British Journal of Sports Medicine that shows physical activity dramatically helps beat COVID. So again, take your vitamin D, make sure you get out and stay active, and that's your best defense against COVID. So in summary, what we saw last week was the dollar continues to struggle at its 40-week moving average. That's good news for the reflation trade, which is clearly intact. A higher commodity market, or a firm commodity market, and firm yields suggest that the economic activity around the globe is real and meaningful, and is going to push the equity markets higher. We're seeing a tailwind, if anything, but certainly no problems in the credit markets, and stocks continue to make all-time highs. That being said, while the S&P is making an all-time high with strong market internals, meaning breadth and leadership and momentum, the NASDAQ isn't quite there yet. It may get there shortly, but again, should these divergences continue, it would portend the potential for moving into a trading range some point in the months ahead later in the year. Finally, the overseas markets were strong as last week as well, particularly in the developed markets, with the DAX hitting a new all-time high in its history. I've been Mike Hurley, Chief Market Strategist for NexPoint. Thank you for attending our deep dive on the markets for April 19th. I hope to see you next week.